Hello, everyone, and welcome to today's PropMoto webinar. As always, I'll be your host. My name is Franco. I'm the editor and co-founder of PropMoto. Really excited today to talk about the art and the science of real estate fundraising. This is obviously a huge part of real estate. You know, most deals don't happen without somebody else's money being put in, and how you work with investors, how you bring the money in, really can make or break pretty much any real estate deal. Obviously, it's been a tough, year and a half / 2 years for the industry. We've seen a lot of money dry up. People have gotten scared away by a lot of headlines about the end of the office, the end of cities, the end of everything as we know it. And but I have heard that there are positive signs, right? Things are looking up. I think we're starting to get back into what I would call maybe somewhat of a more normal real estate environment. Obviously, interest rates are still elevated. A lot of question marks with federal policy, but in general, I think people are starting to see, positive economic outlook in a way that is pushing more money into real estate, and so how to get that money and how to structure these deals is something that we will be going over today in depth. This is a live conversation, so we would love to hear from you guys. We're not going to save time at the end for questions. We would love for you to just drop in any questions or comments you have as we're talking. If they are good and pertinent, we're happy to answer them right on the fly. So you can see down here, you have a Q&A button, and go ahead and type in any questions you have, and we will address them as they come. Thank you guys all for joining. So without further ado, I will introduce our two panelists here. We have Asaf Raz. He's head of marketing at Agora. It's a real estate investment management company. Hi, Asaf.
Hi, how are you, Franco? Thank you so much for letting me join the webinar.
Of course, great to have you. And last but not least, we have Brad Hargraves. He's founder of Thesis Driven, a media company. Hi, Brad.
Hi, thanks so much for having me on.
So I think I would love to start this off with just a state of the real estate industry / real estate fundraising. Like I said, there has been quite a roller coaster over the last year and a half. I think hopefully we're on an upward trend. Obviously, there's a lot of question marks, but looking at where we have come from, I think I see a lot more smiles from the interviews that I give recently than than scowls. So Asaf, maybe you could start off here and just kind of give us an idea from who you're working with and the clients you guys have. What's the kind of state of the investment landscape?
So I'm a data person, right? I come from the tech side of real estate, and the way that I can speak to the market and what's going on fundraising is from what I know from the data. And we recently put out a report about the state of fundraising going into 2025 and what companies have been doing so far, right? And you're right, there was this like negative sentiment of, office is dead, right? A lot of headlines for office is dead. Lots of headlines for like what's going on in multifamily, or, GPs, owner developers are gonna pretty much not gonna make it through interest rates. And then we had administration changes. Like 2024 was extremely unstable, I think, from the conversational standpoint of real estate. But what we've seen is that owner developers actually tried to seize the moment. And there are a few trends that we've seen there that are really interesting. So everybody tried to put multifamily. They're like, people are over leveraged in multifamily, but we're seeing this is the most prominent asset class still to date. Also in 2024, 65% of capital raised and over 53% of just returns come from multifamily to investors, which is pretty cool. I wasn't expecting that result, right? I was waiting for something horrible to happen, which it didn't. We're also seeing a lot of movement on Class B offices. So people are trying to take Class B offices, converting them to Class A offices, just because of how people are moving around through specific regions. So that's been a trend that we've seen. Industrial has been pretty big. Last mile, warehousing, for example, has been big for us. And also we are seeing that specific regions are being focused on for fundraising and investments, right? So it's not national, right? It's not that easy to get money today as it was, pre-interest rate inflection. So, but we're still seeing the growth. We're still seeing the growth. We're still seeing people raising capital and deploying into real estate. They're just doing it much smarter, more specific, and very, very accurate. I think that's what we're seeing right now from a high level.
Great. Brad, how about you? I know you even kind of teach a course on fundraising. I mean, from the people you're talking to and all the fundraising that you have done, what's your thoughts on the state of the industry right now?
Yeah, so I definitely want to echo what Asaf said. Capital is coming back into real estate. This is not the frozen over tundra of 2023 when everyone was reacting to a rapid run up in interest rates. People also at the time, remember, believed that rates were going to come down pretty quickly as well. I think coming into 2025, you it's not that rates have come down so much as some sellers have capitulated. And there's also no longer a belief that there is going to be a rapid decline in rates on the other side of this. This is kind of the state we're in, and people have to figure out deals. And one word that Asaf said that I really want to double down on is accuracy. The days of people just going out, new sponsors, raising for yet another generic Sunbelt multifamily value add deal, that's not coming back anytime soon. But there has to be some differentiation among sponsors. When we teach a capital raising course out of thesis driven, and one thing we really emphasize is when you're building your sponsor profile, think about differentiation both on a sponsor level and on a deal level. How is this different than, just another generic multifamily deal? And some sponsors take that so far as to say, hey, we're going into a different asset class. We are going into a tertiary market. We are thinking about things in a really different way. And I think that's ultimately healthy for the real estate industry. So you are seeing capital come back. You are seeing investments happen. People are, less so on the institutional side, I would say more so on the retail and family office side. Capital is coming back.
Yeah, that's great. And it makes sense, right? That people wouldn't just kind of, spray and pray with their capital now. Investors also generally have, a thesis that they would like to invest off of.
Correct.
And so they're looking for funds that kind of match their view of the world. We have our first question in here I'd love to address. So are there any specific trends you're seeing when owners are converting Class B offices into Class A offices? Asaf, you mentioned this, and I think it's an interesting one, right? I think
Yeah.
there's a huge skew, right, between the Class A that, Class A plus seems to have great occupancy, great leasing. Class B, Class C is still pretty dismal, right? So, how, what are people looking for when they're buying these Class Bs, and what does this look like? This kind of, converting it to a better asset.
And I think for what we're seeing, and this is again echoing back to what Brad is saying, is that we're seeing migration of people moving to live in different places, right? And we're seeing also employers moving into those specific regions. For example, the Southeast, right, which is the top performing region last year. And what happens is when employers migrate there and people migrate there and move to live in those areas, what you're going to see is Class B offices that need to be filled up with people, right? People are going back to office. The Trump administration is very clear about how that's going to work. That's going to influence the entire industry. It already is influencing the entire industry. People are going back to office, right? At least 3-4 times a week. So there's no other choice than converting Class B to Class A offices, right? If you're in a main area that has, a lot of new people living in that area, right? You need to give them the solutions, the employers, the solution to actually put people in office. So I remember in COVID era / post-COVID era, everybody said office is dead, it's done. And I remember seeing CEO related to Jeff Blau in his building right in Hudson Yards here in New York. And I was like, are you experiencing anything like that? And he was speaking on stage and he was like, not at all. Like I have 100% occupancy. And the idea is that if you create a great environment for people to go back to and work in every day, the conversion just makes sense. So not every Class B office would or could become a Class A office or an A plus office for sure. It really depends on the area and the development of the areas around it. And most importantly, employers coming in. I believe, and I'm not an oracle, so no one really knows where it's going, but with the current administration, where things are going, we're going to see more and more employers moving into having more employees in the States, right? So that's going to push a lot of the office movement here as well.
Sure. Yeah, I think it's so interesting. I'll get you in a second, Brad. But they didn't, before COVID, everybody just worked in the office, and that's just how it was,
Yeah.
right? If you had a Class B office, that was just your life, right? And it seems like we have gotten over the, hey, office is, optional, but I think, companies still understand, like, well, you still need people to want to come to the office, right? It can be a tool for, retention and getting new talent. Of having a cool office still has a huge value. So I certainly see that those, A and A plus are doing better. But Brad, interested to hear what you have to say about it.
Yeah, absolutely. I think we're seeing a big shift. People looking at the office space that exists today, people looking at the office space that needs to exist and say, how do we turn this into that? And it's not just about putting lipstick on the pig. And I think that was a lot of what office renovations, value add looked like over the past 40 years. Go in, freshen up the lobby, put nicer lights in, and that was kind of it. Maybe, redo some of the bathrooms, whatever. That's not what you can get away with today. It's much more about operations, it's much more about experience, and tenants are willing to pay up. I mean, one of my favorite charts of the last 5 years is that even as office occupancy sagged, even as leasing velocity dropped to almost nothing in the pandemic winter, price per square foot of new leases signed never fell and actually went up. And so what we're seeing is clients are willing to pay just as much more per square foot. And if it's become even more of a priority now because they actually have to convince people to come back in. It's not, you can't just put a gun to their head and force them. It's you have to entice them. And it's not just about having a nice, pretty lobby that you show off new tenants. It is about operations. You saw this with CBRE's $800 million acquisition of Industrious just a few weeks ago. I mean, they already owned a decent chunk of it. They bought the rest. But, you listen to their earnings call, talk about this, and it is all about them being an experience platform, experience being what is really key in converting those Class B offices to Class A. It's not just about the paint job. It's not just about the lights. It's about, do you have that kind of experiential provider that's providing coffee, that's cleaning everything up, that's doing the room bookings, that's just making people feel like it's a little bit more of a hospitality experience. That's what gets people back in.
And from a fundraising perspective, it's a little bit more difficult, right? Because construction loans are particularly the hardest. Like, those are the ones that dried up the most with the kind of regional bank failures, right? So now you're looking at not only having to pick up a new asset, but get people excited about what is going to be a long and expensive rehabilitation process. Brad, how would you pitch this if you were trying to get investors? Let's just maybe use this as a good example of maybe what you can say and to investors to get them excited.
Yeah, so certainly I think going back to what Asaf said, you have to pick the right region. You have to have those macro trends behind you. I mean, if you're going into a shrinking city, there's a ton of vacant Class B office space in suburban Chicago.
Just a
You are
good buy
never,
side
ever,
high.
ever going to be able to raise money for that because that's not where jobs are going. You're not in the path of growth. But finding assets, first of all, find assets in places that are growing. Charlotte, Research Triangle Park, Atlanta, places like that where there is job growth, there is good momentum, and then find thesis aligned investors. And often I encourage people in our fundraising class, sometimes it's just you haven't touched enough investors yet. You haven't gone out to the right people. Very tough to find family offices. There's almost 10,000 family offices in the United States. And this is saying, if you know one family office, you know one family office. That you can't paint them with a brush at all. So you talk to one family office and they say, Class B office to Class A, that's the dumbest thing I've ever heard. People are working from home forever. You talk to the next family office and they say, wow, we've been thinking about that thesis for the past 18 months. We're so happy we met you. Let's do a JV. So it's part of it's just about filling the top of the funnel. Now, I would say you got to bring the data to the conversation. You've got to frame your sponsor profile in the right way, really be able to talk about your track record. How does your experience make you uniquely suited to do these conversions? Be conservative with your estimates. I mean, there's, doing these conversions, especially in the office sector, you can pick a lot of different numbers that all sound good, but ultimately it's about building trust with that investor. And also understand the first deal you show them is probably not, particularly for family offices, it's not the deal they're going to do. They want to build that relationship over a longer period of time. They want to see you do a deal or two. And that could be frustrating. That might mean you're going out and raising a syndicate. It might mean you're going out getting much more expensive capital. But those can be great long-term partners if you invest in them the right way.
I want to get into the different types of raises, but before we do, we got another question that, especially Brad, I know with your experience, you can field here is, how about Class B and C offices into residential? This one is asking in New York City. This was kind of pushed as the way to turn our glut of offices into something that could help us with the affordable housing crisis in a lot of major cities. Doesn't really seem like it has panned out the way that people would have liked it. Brad, I know you have done some of these conversions in your past life at Common. What can you say kind of about the office to residential conversion? Maybe why hasn't it taken off like some people would have hoped?
We've done some of these conversions at Common. We managed some conversions other people did, and we've written a lot of thesis driven about conversions and kind of when they work, when they don't work, why don't they work, why are some of them fine? One thing I would say is that the tone is very has gotten very negative around office to residential conversions, but the pipeline of ongoing office to residential conversions is bigger than it's ever been. It's about 77,000 apartment units currently undergoing conversion from office to residential. So people are doing it, but there's some real barriers to making it work, and it's not the solution to the housing crisis. One just kind of obvious barrier when you think through it is getting a fully vacant office building is actually really hard. Most office buildings have different tenants on every floor, and not all of the leases expire on the same date. So even a building that is severely distressed, 60% vacant, selling for pennies on the dollar, still 40% occupied, and you have to find some way to get those tenants out or sit on a really money-losing asset for a long period of time. Mm-hmm. The second big reason is simply one of structure, of floor plates. Offices, particularly the kind of offices that are in most distress right now, tend to be these mid-century fat boxes where they have really thick floor plates because the executives in the conference rooms were ringing the exterior. They had windows. Most of the working stiffs were in the middle of the office near the elevator core, and they didn't have windows. So that doesn't work for residential. Residential apartments need windows. Bedrooms need windows generally. Living rooms need windows. So that's just tough. That's hard to solve that problem. So you see different solutions to it. You have what Metroloft has historically done. They've been doing office to resi conversions in New York's financial district since the 90s. They like to blow a hole in the middle of the building, which is obviously incredibly expensive, and use kind of a light well model. So that works when you have New York City, Manhattan condo prices north of $2,000 per square foot. You can put a lot of money, you can lose some floor area, you're fine. Most buildings aren't like that. Oddly, a lot of the earlier pre-war office buildings tend to work a lot better because they have setbacks and narrower floor plates. So most of the office to resi conversions that we have seen tend to be those pre-war buildings. Unfortunately, the places with the most housing demand, the Sun Belt, they weren't building a lot of beautiful office towers in Charlotte, North Carolina in 1925, sadly. I'm not sure what was in Charlotte in 1925, but it wasn't much. So you don't have the same bones in a place like that to do those conversions.
Mm-hmm. Also, if you have anything to add, have you seen anything when it comes to the office to resi trend?
So I would actually like to jump a little bit, zooming out into more of the fundraising piece of this, right? Because we really focus on office right now. But I think there's two things that Brad was speaking about, which I think are worth mentioning, right? So how do you get people interested? If it's office, if it's industrial real estate, if it's residential, whatever it is, how do you get people interested to invest in those deals? And I think that's the important piece here, right? And for example, Brad's knowledge in office, if Brad was raising capital today for office conversions, I would definitely be interested in hearing more, right? Because he has the expertise and the knowledge of the business and the area, right? For example, New York. So I had a recent conversation with two owner developers in Miami, right? One of them is called Josh Sassone, who he does like multiple different asset classes. And one of the things that I really like about what he does, and he mentioned this, the way that he raises capital, he has this sentence, he says, design with intent, right? So he takes industrial assets, he takes office assets, he takes residential assets. And what he thinks about is what's the intent behind building out those assets? Like what's going to make sense? Because I'm buying something that might be pretty old, like even sometimes in New York, it could be pre-war, right? But in Miami, it's a little bit different. But what is my intent? What am I trying to achieve through that? What's the message I'm trying to deliver to my potential tenants in the future? That's what's going to sell to my investors, right? That intent behind what I do. Because the investor needs to know one thing. The investor needs to know that you can return them the money. How can you return them the money if you get tenants in to pay, right? So there's this thing that I really like. He calls it design with intent. Now, another thing that is really interesting is a company named AJ Capital. They're pretty big in the Miami area, and they have specific expertise in Miami itself, right? Me or Brad or any other GP won't probably go and do what they're doing right now in a place called Little River, which essentially is an area within Miami that had honestly nothing there, right? Mostly kind of abandoned commercial real estate. They virtually bought in the whole area, and their vision is to redo the whole thing. So a lot of commercial assets, a lot of shops, a lot of coffee shops, and make this entire thing a walkable area and virtually create a new neighborhood. And what they're doing, the way that they're raising capital around it, is they're telling the story of Little River, right? And that's how investors are coming in. So they're doing office and they're doing industrial and they're doing residential, right? And they're just telling a beautiful story that has intent behind it of why people will come. I was in Little River 2 months ago. I was sitting in the most incredible coffee shop. Right in front of me was a secondhand shop. Both of them was theirs, like a thrift shop. Both of them was theirs, but that's the only thing you see around there. The rest of the area is pretty quiet. There's nothing there, but I can envision how this grows into a walkable area with a great place to live, with Class A offices, right? With beautiful multifamily buildings, a bunch of community activities. They're doing a bowling alley. They're doing restaurants in that area, right? They're a very powerful developer. But I think going back to the message of like how to raise capitals for deals today within this market, I think that you need to either have the intent behind the type of deals that you're doing or the expertise in the area, right? Again, Brad would probably not go today into Little River and invest all of his capital in that deal, right? But AJ could do that because they know the area pretty well. And that's where it ties back to offices, right? If you're doing Class B conversions, right, to residential, you should know A, how it works, and then B, how much time is going to take you, what's the investment going to look like, and you're going to get the investors to jump in on that wagon. I feel like that's I think my 2 cents around how to raise capital in those kind of complex deal structures.
Interesting. Yeah, it goes back to what you're saying about that kind of hyper regional focus, right? Where it's really tough right now to just say, "Oh, I'm going to convert, offices across the country." That's a hard pill for a lot of investors to swallow. But if you say, "Hey, this one area, this is the perfect area for it," that can obviously, help differentiate and get people excited, right? Because they can really, like you say, envision what it would look like upon completion. I have a couple questions here about pace or C-pace, but I want to get into them in a second because before we do, I kind of just want to do a little primer about kind of different types of deal structures. I think depending on how you structure deals, you're obviously going to have a different, task of getting investors excited. So, maybe Brad, you could start us off here and just kind of let's do a quick outline of the different types of structures. Obviously, there's the syndications, there's the deal by deal, and maybe give us a little bit of a understanding of how each of those kind of changes the strategy a little bit.
Yeah, absolutely. So, there's a few different structures that are important to know. Obviously, you can go deep into the weeds and talk about a lot of different things, but most GPs at the early stages are going to be raising single asset syndicates. And by syndicates, I don't necessarily mean they're going to, CrowdStreet and raising from, 200 retail investors. I just mean there is a single asset, there is an entity that owns that asset, and they're raising into that entity to buy a single asset. Those tend to be the simplest. And frankly, even a lot of experienced real estate GPs prefer single asset syndicates, mostly for the reason, even though it can get a little more annoying to have to go back to your investors for each and every deal you do, you're not crossing your deals. So if you have one deal that is really not doing that well, it's not going to bring your entire portfolio down and take you out of the promote. So there are some good reasons. It's not just like the introductory structure that's only good for beginners. There are reasons why some of the best real estate developers out there use single asset syndicates. Moving forward, you can think about a fund structure as well. And a lot of people talk about raising a, propco fund, raising a real estate fund. In practice, they don't always mean a real estate fund. In many cases, they're doing something that looks a little bit more like a dedicated account. So they find a capital provider that says, hey, I'm going to set $20 million aside. I'm not going to give it to you right now. You don't have discretion, but it's set aside and here's our deal box. So here's the type of deals we want to do together. Come to us when you have deals, and if they fit the box, we can do them out of this dedicated account. A fund generally implies discretion, meaning the GP, they have decision-making authority over where they raise 200 million. They can deploy that 200 million as they see fit. Obviously, whether it's into a single asset syndicate or a dedicated account, that matters less to an LP than discretion. Are you handing over control of signing off on each and every investment? That's very hard to get from a GP standpoint, certainly from a new GP's standpoint. There's obviously other structures beyond those two. We see a lot of joint ventures now where a GP might partner with something like a platform investor that says, hey, we are going to give you some operating capital in addition to providing deal by deal capital on the sites that you are coming up with. They're sort of buying a piece of the GP. You also see new models that kind of riff on that, and some of them I find very interesting, like what Moses Kagan and Rhett Bennett are doing at Reseed. Reseed is a accelerator program of sorts for real estate developers. They just did their second cohort. They're based out in LA, and they're really looking for people with, to Asaf's point, deep market expertise. So they want to find the best commercial investment sales broker in Augusta, Georgia, and say, hey, we are going to invest a little in your operating company. We are going to pay your salary for a year, for 2 years as you get started. You can hang a shingle somewhere. You don't have to go out of pocket for all that. And then we have effectively a first look at all your deals, and we get a little royalty co-GP share on the deals that you're doing. So those are some of the big types of structures and some of the variations. Obviously, you can go way deeper into this. There's a lot of REIT structures people are playing around with, private non-traded REITs. I don't know if that's too deep in the weeds for this, but there's all sorts of things. But single asset syndicates, funds, and joint ventures are going to be your main structures you want to look at.
Interesting that they're doing like a hybrid approach, right? So you kind of get the best of both, right? You can sell off the single asset and also a little bit of a piece of the operating. Asaf, what have you guys seen when it comes to people using your platform? Is it mostly single asset stuff, or do you see more kind of large syndicate plays?
So it's very interesting, and I think it goes into Brad's point. And what I'll do is I'll try to build it up towards what the larger players in the market are doing today, right? What we're seeing is that usually you'd start with a syndicate or a deal by deal structure. You'd grow into building a portfolio. You'd grow into building your company. Usually at a certain point, the most comfortable vehicle, once you build your rapport and people know who you are and they trust you, right? You'll go into building a fund. It's just easier to raise capital and deploy that capital into the deals that you know how to do and you're an expert in and people believe you, right? It takes a few years, sometimes 20 years, right? But when you build that portfolio, and some companies, by the way, don't do that till this day, right? So a great example, right, of a company that I'm really a big fan of is Amherst. They're in residential real estate, right? So they have all types of vehicles that they work with to buy residential properties, right? The idea is that, again, what we're seeing is that as you grow, you start building it into a fund because it's easier to deploy capital and get the access to the capital. What we're also seeing, which is pretty interesting, is the return of, I would say it's been many years in the making, but of debt funds, which is extremely interesting because of where interest rates were at. Debt funds were pretty close. And sometimes if you negotiate well, we're even under what the national interest rate was. So you've seen a lot of those debt funds coming up and saying, hey, we can provide that capital. So they raise their own capital and deploy that into other GPs. Honestly, like, I don't know where it's going to go because the returns are not as big as, just investing in a regular real estate fund. But some institutional players love to invest in those type of structures because they're just a little bit more secure, right? And then the last thing that I'm seeing, that's the extremely interesting part, and this is more to the larger or the I would say the high end market, is institutional players are looking to get access to retail investors' money. And that's really interesting, right? Because this is something like I don't see an institutional company, reaching out to 1,000 investors to try to get their money, right? Or try to get that money to flow. So they're using something called a transfer agent, right? To get access to that retail capital, which is, again, it's extremely interesting because they have access to so much money. And for them to want to go also into the retail investor minds, try to get their money as well, to deploy into different deals, is also extremely interesting. And I think this is going to grow with time. It's going to create a big shift in where money is flowing. But definitely we're seeing that with the larger institutional players trying to reach or get the retail investors' money and to get into their hearts and minds.
Interesting. The hardest part of real estate in the last few years has been finding, efficient cost of capital, right? Finding, lenders that will even lend on some of this. A lot of regional banks have obviously pulled away. I'd love to just talk a little bit about the debt, the type of debt structures, maybe what types of debt investors are preferring. We have a couple of questions that came in about kind of pace, which, I know from the people I've talked to that, oftentimes there's a lot of debt that kind of needs to be stacked on top of itself in order to make these work, right? It's not like before where you could just kind of go to a regional bank, get your debt and have it be done that easy. So it's more of a stack, right? Asaf, I'll start with you. From what you're seeing, what are the kind of types of debt structures out there that it seems that investors maybe are preferring?
I'll start with what's happening with existing loans, right? Or with the existing debt out there. I think that's the really interesting part because people believe that's going to kind of crumble in the market with interest rates going up. I think what we're seeing is that, it's a very different situation, right? But all these lenders are looking at 08, okay? Like we can't shy away from that. And in 08, they ended up having a lot of properties and no money in the bank, okay? That's something that no lender today wants to get to. They just don't, right? So the way that what we're seeing is happening, we're seeing actually a collaboration. It started end of 23, early 24, where interest rates spiked. We've seen those lenders working very closely with the owner developer, with their GPs, with the funds, whatever, to try and create, I would say, health programs to help people pay their debt back, right? So essentially what you've seen is instead of lenders taking over properties, we've actually seen them working together with the GPs to create a better structure of the loan or restructuring their loan without refinancing and higher interest rates, just so they can get, pay the money back. I think that's one thing that's really interesting, that collaboration. And GPs have a very strong leverage with that, right? Like your lender is going to work with you. They don't want your asset. They want your money, right? So there's always a place to talk and negotiate there. And when we talk about specific types of funding, I think that what is very interesting for me is not the structures themselves. I think Brad can talk about that more than I do, but it's the percentage of debt that is being deployed into deals. And some of the players that I've been speaking to are actually making decisions to sometimes, for example, if they go and buy land, so they do land deals, right? They would raise zero debt. They would only raise LP money, put in their own money, right? And then bring in an external GP to take a commitment to buy property on that vacant piece of land. Some of them are structuring their deals with 10%, 7%, 15% debt, just because of where interest rates are and just because how they can work with investor terms. So sometimes they'll create, for example, a fund and they'll lock in the money for 2 years, hoping that interest rate might go down at a certain point or just like stabilize, and take in more LP capital and only start paying back after 2 years or 1 year, which gives them time to build in those properties. So I think, again, Brad can talk more about the specific types of loans here, but I think for me, the interesting piece is how do they structure that into their deals? And that's been a key piece here that we've been seeing as well.
Interesting. Brad, what do you think? What are you seeing as far as what the kind of debt structures that are actually getting deals done right now?
Yeah, so there was a moment probably about a year ago where I think everyone thought that pref equity, these mezz structures were going to be the next new thing, and a lot of people raised a lot of capital into these pref equity mezz loan debt funds because what they saw is, exactly what you were saying. All these maturities were coming up. And they looked at this and they said, no way are these owners going to be able to refi out all these loans that are coming up for maturity? Well, what really happened is a couple of things. One is these pref equity mezz debt structures were pretty ugly. Like they came at pretty high rates. We're talking 13 to 15% usually. There often just wasn't enough room in the capital stack of these assets to allow these mezz lenders to deploy the kind of capital they needed to deploy. So not a lot of this capital actually came out. And then exactly what you said, I mean, it was a very generous way of describing extend and pretend, which is, they have a conversation. The lender doesn't want to take the keys. The GP obviously is hoping for greener pastures on the other side of this interest rate environment. So the actual steady state is the lender says,
I'll wait.
Let's have a conversation in a year. Maybe things will be different then. Yeah. And, I think there was some thought that like, okay, well, regulators are going to crack down on this. Like regulators are smart to what's going on. They're going to start tracking and pressuring banks to put more pressure on the holders of their debt. But I mean, that's not happening in this administration. So like, it's unclear that a lot of this debt will actually get out the door. I think the exceptions are things like CPACE, where, I've never done CPACE myself. We published a deep dive into CPACE by Laura Rappaport, who is the CEO of Northbridge, big CPACE lender. People are able to get some great terms using CPACE. I have another hospitality developer in Texas who I know well, who wrote for Thesis Driven, who's also using kind of CPACE as part of their capital stack. So I can't speak too specifically about it, but I do know specific developers who are using it successfully to bring down their overall cost of capital. And evidently, even though it says like, it has to be environmental in some way, it's technically like an environmental rule. Everyone I talk to who does CPACE is like, the whole is it's a very wide definition of what qualifies as like clean energy, environmental to qualify for this financing.
Yeah, if you're doing
a lot of people are using it.
If you're doing any sort of building upgrade, it's likely going to be more energy efficient, right? So
right, exactly,
would qualify for it in a way. And we've talked to Nuveen, which is one of the kind of largest CPACE funders, and it's definitely not the easiest loans to get. There's a lot of hoops to jump through, but I think if you can secure it, it seems to really be helping a lot of operators get over that hump, right? And maybe not having to take down such a big initial loan that they can add the CPACE funding to it. I'd love to get into a little bit about the different types of investors here. Obviously each one has a different profile and a different way of dealing with them, right? It's kind of hard to have a conversation like this about every investor and kind of paint them all with the wide brush. So let's maybe break down the different types of investors and kind of go over what are maybe some of the best practices when it comes to dealing with them, right? This is a noisy environment. Everybody's looking for money and they're probably all getting lots of solicitations. So Brad, I'll stick with you on this one. Can you maybe break down in your mind what are kind of the large buckets of investors and how they kind of differ and how they operate and how they work?
Yeah, totally. So I'll roughly order it in terms of kind of going up the sophistication ladder. Starting with retail investors. There's obviously accredited and non-accredited retail investors. Most developers at this point are choosing, to go out under Reg D 506C, which says you can raise unlimited capital from non-accredited investors. Um, and you know you don't have the tight reporting requirements of Reg A plus, Reg CF, some of the other ones that allow you to raise from non-accredited investors. And at this point, like, you know, the definition of accredited is a lot of people can fit into that definition. So there's not a lot of benefit I see most people seeing going out and raising from non-accredited. Can talk more about that. So that's kind of the first bucket is your retail investors. You go up, kind of high net worth individuals to family offices. As I said earlier, very hard to describe family offices uniformly. It's a good and a bad thing. It's tough in that I can't give a lot of generalized advice about family offices. It's hard to do that. Anyone who says they can do that is lying to you. The plus is that they invest in some kooky stuff. And like if you've got a kooky thing that may or may not make a lot of sense, maybe you should raise from family offices. It's almost in the banking, real estate private placement world, it's sort of like a way to insult someone without like really insulting them is, you look at their business plan and say like this would be great for family offices, meaning like maybe you'll find some rich scion who's like crazy enough to invest in this thing. But that said, family offices are a great fit for a lot of ideas in real estate, and a lot of sponsors would be best off going out and raising from family offices. Go up one click, private equity firms. Real estate private equity investors. You have real estate funds. They can range from pretty small in size to absolutely, massive. Your Starwoods of the world looking to go out and do JVs with emerging sponsors. They are going to expect some kind of track record here. They're going to expect that, a developer is coming, they've done a few deals, they can show the results of those deals. They also, and one thing we haven't talked about are fees and requirements. They are really going to, private equity firm, if you're doing a partnership with them, they're really going to squeeze you on the fees, and you will have much tighter reporting requirements generally than you're going to have with a family office or certainly retail investors. I'd kind of break hedge funds off from that a little bit. There are some hedge funds that have real estate specific investment strategies, generally can take more risk, generally are much more sophisticated. Some of the probably the most sophisticated group kind of in this set. But you do see some of these hedge fundy firms, getting out there. Maybe they'll do some debt, maybe they'll do a little bit of equity, generally shorter investment time horizons often, but they are important to call out specifically. And then finally, you have your institutions. And you can talk, there's obviously a lot of different things. You have your allocators, you have the firms that invest in allocators, your sovereign wealth funds, pension funds, insurance companies, et cetera. They need to invest at scale. You're not going to get money from one of these allocators, one of these institutions, unless they can get, frankly, at least $500 million out the door in 2 years. And and they're not just like going to take your pinky swear that they can invest $500 million over 2 years. They need to see validation. They need to see a pipeline. They need to see a track record that you can invest that kind of capital. So generally, the only people raising from institutions are, unless you're in a super, super hot sector, data centers, are people with deep, deep track records. Sure. So yeah, happy to go into any more of those categories, but those are going to be your big food groups of investors.
That's great. No, that's a great breakdown. Asif, obviously, I'd love to hear from you just how, with these different investors, how are people communicating with them? How are people, they have different levels of compliance that are needed, right? I know a lot of this happens through your platform. So maybe, break down a little bit of how that works, and maybe how technology can even kind of help do some of that reporting.
Yeah. So I'm going to touch on 3 points that also Brad mentioned here. Compliance, right? Which is going to become more and more critical as we go into 26, and I'll explain why, right? Reporting, and just, different type of investors management, right? Different type of, a lot of funds or a lot of syndicators would have multiple types of investors investing into once, like the same deal. How do you get around that? Like, how do you work around that? So I'll start with the compliance piece. The SEC just put out a compliance regulation that by the early 2026 or January 1st, 2026, you're going to have a compliance officer running through your AML process, KYC processes, and investor accreditation. Through most of the regs, Brad, correct me if I'm mistaken. I think for sure on 506C, especially when you do unaccredited, but you're definitely going to need someone like that in your office, and GPs are kind of thinking about that very deeply. So compliance is extremely important, right? And this is something obviously we do on our platform. We also are looking into providing that compliance officer to actually help people run through that regulation, but also everything is kind of automated through the platform. So when you think about it from a standpoint of a GP saying, hey, how will I manage all this compliance piece, right? Having tech that does it for you is just like, you don't even need to think about it, right? Your investor goes into this flow, everything is automated, you get a response back, accredited, not accredited, KYC, good, not good, check this, check that, right? It's just very simple. People sometimes still do it manually for a reason. I honestly don't know why, or look through like external players. Just do it with tech. It's super easy. We do that as well, right? So the compliance is the first piece of this. Again, and I think the overarching line would be like, try to automate this thing, and it's possible. People do that. We do that as well. Now let's talk about reporting, right? Different types, or I'll start with the structure, with the different types of investors, and I'll go into reporting. Different types of investors have different expectations of what they want to receive, right? So your everyday retail investor is going to really enjoy your report that you send them just to see how everything's performing. And when tax season comes in, he's going to want to get his K1 on time and just, submit it to the IRS. Okay, great. That's cool. Right. So that's your retail investor. When you go into family offices, things get a little bit more complicated. They need reporting from different structures. They invest with you from different entities, right? The calculations, the waterfalls, the distributions, everything looks a little bit different. And that's really hard to manage at that point. Now, if you pull into that a hedge fund, or if you pull into that a debt fund, or if you put into that a institutional player, they have very different expectations. So an institutional player, for example, would have very specific ways that he would want to receive reports. Will have specific reports he's going to require from you to get, right? And they won't play with you if you don't do that for them. Okay, that's like point blank. They just won't invest, right? So it's not only the experience that you have, it's your ability to operate this. So there's a lot of operational work being done here. And also understanding, how do I make the calculations, right? So let's say I have a different 100 investors, let's say one class of investors, 20 investors have these specific terms, and these investors, 20% has these specific terms, and they all get specific different terms. They need to sign different documents. They need to go through different processes. The calculations need to be different. And then how do I communicate with them, right? How do I communicate with an institutional player versus a retail investor, right? So obviously I'm biased, but my point of view is it should all be automated. All of these requirements, all this onboarding for investors, all the KYC, AML processes, the compliance accreditation, the fundraising itself, investor needing to sign only what he needs to sign, getting the reports the way they want to receive them, and your ability to customize it and make it super simple instead of sitting on a Word or a word sheet or Excel sheets and doing the calculations and plugging everything in. The ability to actually transfer money to and from investors, not going through bank accounts and doing manual work, right? So all of that can be automated into a single unified platform. This is what, for example, what we do at Agora. So we help run all of that fundraising piece and calculations, investor management, and most importantly, the investor communications, right? So end of the day, and this is a huge trend from the last few years, I would say at least 15 years in real estate, but even more in other traditional markets. Like, investors need a very simple portal they can log into and see the performance of their assets, the performance of their investments. Again, it's just, but nowadays it's a given. Like, if you don't give me access to the information like that, I won't work with you, right? So some of those old-fashioned real estate investors, they used to just work on Excel sheets, and then the investor would call them and say, hey, I need this report, or how's my asset doing? And they would say, I'm going to send my analyst and he's going to come back to you in 2 weeks, blah, 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 right? So I think for me, the way to do that is tech. I'm biased for tech. You can automate it, you can streamline it, you can make it really, really easy for you internally to operate on that. And eventually it helps you create a really, really good experience for investors, which is extremely important to create a great experience for them because they're going to come back and help you grow more efficiently,
Sure.
like just making more money. That's my take on investor relations, communications, fundraising.
Yeah, and using the word reporting, I think it's kind of, it steers the conversation towards the financials, the spreadsheet, all of that, and I think that's kind of bare minimum, right? There's also a rapport building element to this, right? It's not just about here's my quarterly reports and thank you for your money. There's some communication that is involved that I think really helps build that. And Brad, I'd love to hear from you on this one. How do you suggest to communicate to the different types of investors, and do they like different types of communication, different frequency, different tone, right? How would you maybe go about looking at the different ways that you can communicate to kind of for each investor what they're actually looking for?
Yeah, absolutely. And I would say the highest level is everyone is looking for transparency. And when I see these things go off the rails, it's never because someone made a mistake, did a bad deal. I mean, that stuff happens. It's because they then tried to cover it up and weren't fully transparent with their LPs about what happened, what's going on, what's the plan to fix it. And so there's a few that's the highest level. That's where things start. And then it breaks down from there across different types of investors. Obviously, reporting is important to everyone. The types of reporting that investors want to see is going to vary based on who they are. So your institution, they are going to have very standard formats of reports. They need to see, you've got to automate that. You've got to use technology to make that possible. So Azov's spot on there in terms of how to do that. And you'd automate all this across the board. For your retail investors, for your family offices in particular, it's about the relationship. So they're going to care. I mean, everyone cares about the narrative. They're going to care even more about the narrative. Family office investors tend to be way more patient. So going to a family office investor, they're going to be more understanding in general if, the market timing wasn't right. They're going to probably be more willing if you need to do a capital call to do a capital call versus a private equity investor. Nope, sorry, that thesis didn't work. The person who led that thesis is out the door. It's a workout at that point. So it's very different reactions from those investors, but transparency sits at the highest level. Retail investors, they may not demand as much, but if anything, it's even more important with retail investors, given the legal requirements and the legal liability of dealing with retail investors, to be incredibly transparent, forthright, and truthful in that reporting. So automation is obviously going to make all this way, way easier and more possible. But each investor, I would say it doesn't vary as much in like the facts, the figures, the numbers, those are what they are. It's really about what is the narrative around those and how are those investors going to respond to that narrative.
What do you think, Brad, about, obviously automation is so critical. It can, make things so efficient, but there might be a downside to some types of automation, particularly like, would you want ChatGPT to write all of your, investor?
No.
Like there's
No.
a certain voice, right? You need them to kind of get to know you personally, right?
Yes, absolutely. I would not ask I asked GPT to do a lot of things. I don't think I would ask GPT to write my investor letter. That's, I don't know. Maybe it might be good enough at some point. I'm generally bullish on where this stuff goes, but it's not good enough today.
Right. But going back to the kind of diversity part, right, or the diversification part is, if everyone's doing that, then you are just one more kind of voiceless, a fund out there. And so I think having a little personality, although I think people kind of try to pull back on that, they try to be maybe overly professional sometimes, but I think having a voice and a personality can also help.
having some attitude, bringing some spirit to it is great. I mean, I think even when you're talking to institutional investors, there's still people at the end of the day. And where the professionalism really matters is in the numbers, in the reporting package, in the financials, the narrative. I think that's where a little bit of, personality can come out.
Sure. And we got one last question I'll field right here because it's really topical is, what makes a good quarterly investor letter? Brad, I'll start with you on this one.
Yeah, I just go back to what I said. Obviously, the best ones I get from GPs I've invested with. So just thinking about it like that as an LP, like what lands well with me. I mean, they're going to write a page, probably, hopefully not more than a page single spaced of like what happened at the property this quarter. How are they feeling? Like, don't blow smoke. If it was a, bad quarter, say it was a bad quarter. Say why it was a bad quarter and say what we're doing to make next quarter better. So that forthrightness, that transparency, and then just like straight into the financials. So summary numbers, your whether it's your cash flow statement you're looking at, your income statement for the property. And then I think some additional color is often helpful if you want to give more special reports around, around churn, around lead volume, whatever the problem is. Like if the problem is a marketing problem, talk about that. Give more data around that. If the problem is a churn problem, give more data around that. If it's you're going through a big renovation, share more data around that. So don't just not one size fits all. You have to adapt it to the scenario and situation that you find yourself in on a deal by deal basis.
Asaf, lastly, do you have any kind of suggestions for a good investor letter? What do you see that has been the best?
I do, and I'm gonna actually take it not the professional side like Brad did. I'm gonna take it more for the basic side. Don't have typos, right? Okay.
Yeah.
Make sure all your lines are in place. Make sure your logo's in the top.
Looks good.
You need to make it look really professional. Like investors want that. When I invest with someone and I get a really professional quarterly report that just looks great at first glance, I'm like, okay, this is really cool. It's building confidence. And I'm a marketing person, right? So for me, it builds confidence without even reading one word. Even if the performance wasn't amazing, right? Like Brad said, just transparently show it to me. Sometimes even visually, like investors, a lot of times eat with their eyes. Just make it look great. Just make it look great. Build your planning with the visuals. Build your report with visuals. Make sure everything is in line. Like literally, these small things make a huge difference in how professional you are. And I like calling this make your reports institutional grade, even if you're doing it for the retail investor. It's so critical to build the rapport and build the confidence, even sometimes more so than the content inside, right? Sometimes they won't even read that fully. That's my 2 cents.
Great. Well, that's a great place to end. If anybody would like to be put in contact with either Asaf or Brad, I am happy to do so. You can send me an email. My email is franco@propmoto.com. That's FRANCO @propmoto.com. Thank you, everyone, for joining. Asaf, Brad, thanks so much.
Thank you.
Thank you.
Have a good rest of the day, everyone.